Hello students, welcome back to the course Introduction to Accounting. This is going to be the second module of this course, and in the second module we're talking about the chart of accounts in line with our course outline. In the chart of accounts we'll be talking about the accounting equation, we'll be talking about double entry accounting system, as well as the accrual and cost and cash accounting methods, in addition to other illustrations of basically the field of a chart of accounts of an entity. Yeah, let's dive right into it. Okay. Yeah, so basically the chart of accounts is unique to every organization, and it's based on the 5 major account heads. As you can see on this slide, we have said that the 5 major account heads are assets, liabilities, equity, income, and expenses. So every account of an organization, which basically forms the chart of accounts of that organization or of that entity, will fall under one of these 5 heads. Now, the reason why these 5 heads are very important is because they basically make up the accounting equation. Now, you see these first 3 here, the assets, liabilities, and equity, they're regarded as real accounts. And they're basically regarded as that because these are accounts that move from period to period, unlike the income and expenses account, which basically is only retained for a yearly period, like 1 year at a time, right? And that's why you see that the basic accounting equation states that assets minus liabilities equals equity. And that equation can be rewritten as assets equal liabilities plus equity, or liabilities equal assets and equity. It's basically just an interpolation. And if anyone is aware of basically the definition of assets, we can easily go back to our definition of terms here to look at the definition of assets. Let's see if you can find that exactly. So you see, an asset account is an account created to capture a resource controlled by the company or an entity as a result of past events and from which future economic benefits are expected to flow to the company. So an asset basically is a resource of a company, and it's something that the company has or an entity has control over, and it's something that the entity expects will yield returns in the future. A liability, on the other hand, is basically the opposite, because when you have a liability, you're expected to pay someone. It's like you're owing someone. So really, it is an expectation of resources flowing out of that entity. So you will see the definition here, where it says an account is an account created to capture a present obligation of the company arising from past events, settlement of which is expected to result in an outflow of resources for future benefits from the company. You get it? So it's basically the opposite. Assets is what you own, you have control over, which is expected to yield returns for you. Liabilities is what you owe, and which is expected to take resources out of the entity. Now, equity basically is a residual interest. When you own something and you take out what you owe, what is left is regarded as equity. So equity is a residual interest in the assets of a company. So when you have an asset, when you take out the liability, what is left is the residual interest of the owners of that company or of that entity. In a company where there are no liabilities, it is 100% equity. That means the owners of the business own their assets, basically own the assets of that company 100%. And the basis for explaining this, so you can appreciate the accounting equation that says that assets minus liabilities equal equity. So what you own minus what you owe will leave you with your residual interest in the entity. It's as simple as that. If you look at it from this perspective of assets equal liabilities plus equity, you get to understand that assets are funded by the money you've borrowed, which are your liabilities, plus the money you have invested yourself as the owner. And that is why it still is the same thing, really, because your interest plus the interest of your creditors, you get it, equals assets that you have in the company. And that's the whole idea of accounting equation. Accounting equation is more like a circle, as I always say. You must always balance out. Everything revolves around this equation, and that's what makes it important. Now, for income and expenses, why income and expenses, are not included in this equation, although they could be, is because the net of income and expenses flows into equity, right? Because equity is more like interest in the company. So if you have income and you minus expenses, what you have left is more like a gain. That gain flows into equity. So you will get to see all this as we move along. But just having in mind that this equation guides, accounting in general. And the account heads are responsible, for the equations, for the accounting equation.